we've done all the assets. And if you think about your accounting equations, assets equal, hopefully you said liabilities plus stockholders' equity. So guess where we're going next? Now we're going to go through the liabilities. And the good thing is there's really just two big classes, the current liabilities and the long-term liabilities. So we're going to start with the current liabilities and then long-term, and then finally we'll do stockholders' equity as that third chapter. Current liabilities. Going back to the definition of a liability, remember we said it was a probable future economic sacrifice. So the asset is a probable future economic benefit. This is a sacrifice. And the other word that's kind of gotten FASB into trouble is not exactly the right word, but is this word probable. And the reason is if you're a company, often kind of the other side of the transaction, I often debit an expense. The issue is if I'm a manager, do I like to see lots of expenses? And the answer is no. I'd rather see revenue than expenses. As a manager, do you want to see lots of liabilities? And the answer is no. You'd rather show that people owe us, not that we owe a whole lot of people. And so left to their own devices, managers try to avoid booking liabilities, basically using this word probable to mean never. And so that view of what's probable, FASB has to put some very specific rules and say, yes, we believe it's probable, you must book it, and this is when you book it. These are our current liabilities, and the same rule applies here as with assets. That's when they'll be paid within a year. And technically it's, or the operating cycle, but for 99.9% of the companies, it's a year. So that's all we really care about. We put our current liabilities basically in the order in which they're going to be paid. So we start with our accounts payable. That's always our first liability. For a retailer, these are going to be for purchases of inventory on account. For a service company, those are kind of for your normal business expenses. Notes payable, just like we had with notes receivable, these will charge simple interest. And so that's how we know they're not an accounts payable. And if you remember, that was rate times time times principal. For every note receivable one company has, there's another company with a note payable. Just an example, on November 1, you go to the bank, you get a note payable for $3,000. To increase notes payable, you credit, and that always goes at the face amount. And then hopefully we get that much cash. And then we have to have an adjusting entry for December 31st. And the adjusting entry is for the interest. Just like on the receivable side, we're going to use our same formula. So our rate is 0.10. I'm going to leave the time because that takes a little bit of thought. Our principal is the 3,000. And then the time from November 1st to December 31st, 2 months. So that's 2 months up here. And remember, again, this always has to be an annual rate. So even though this is a 6-month loan, that 10% is the amount you pay annually. So we always divide, if it's monthly, by 12 months. So I think this is $50. Our adjusting journal entry is we have interest expense for $50, and we have interest payable. So then when it comes time to pay it on May 1st, I've got to get rid of the note payable. This interest payable has to go away. Again, it had a credit balance, so I need to debit it. Remember, that gets closed out, so that's not showing up in the next year. So that's not even anything we worry about. And we know we need to pay some cash. So let's figure out how much cash we're going to have to pay. And there's a bunch of ways to do this, but we're going to be 10 times 6/12 times 3,000, $150. So the cash that I've got to pay is $31.50. That doesn't balance. I need another $100 in here. What is that? Well, I had 2 months of interest last year. I have 6 months total, so what haven't I accounted for? Interest expense for this year is my 0.10 times January, February, March, April, and this is May 1st, so it's 4/12 times 3,000, which lo and behold is $100. You have interest expense for the 100. Just a reminder on the denominator here, on our time denominator, no matter what the length of the loan is, if it's days, use 365 days. Sometimes they'll give you a 75-day note just to make your life miserable. And for months, always divide by 12. So the next thing is to talk about unearned revenues. We've talked about unearned revenues a zillion times, and this gives me the opportunity to put it on your exam one more time if you haven't gotten it yet. Unearned revenue, it's unearned, which means it's a liability. It's a liability until you earn it. When you earn it, that's when you get to recognize revenue. So this happens when you receive cash before you provide the good or service. So if you're a kitchen remodeler and somebody gives you $2,000 to remodel their kitchen and schedule it for 2 months down the road, that $2,000 is not revenue until you actually go in there and put in their kitchen. One you probably don't think about are gift cards. If Applebee sells a $200 gift card, they're not really doing anything. They're promising to feed you sometime in the future. So when they sell that gift card, that's not revenue yet. When they sell that, that goes into unearned revenue, which remember is a liability. So to increase the liability, we credit it and they get the cash. But they don't get to recognize revenue until the person actually comes in and uses it, because that's when you perform that service. So when the customer comes in and uses it, I'm going to reduce my unearned revenue because they're not going to give me cash. They're going to give me that little card to swipe for the 160. That's when I get my revenue. When you provide the good or service, that's when you recognize revenue. At Christmas time, they always talk about Walmart gift cards. They say they sell all these gift cards, but then there's all sorts of incentives to get you in there to actually use the gift card. They really want you to use it because that's when the revenue is earned. And that's why you have all those after Christmas sales. I know you think it's because they love you, but it's to get you in there and use those gift cards. The one thing I do want to put in here is, does everybody always use their gift card? And the answer is no. And so they call that, which I think is kind of funny, breakage. They do get to estimate breakage. Just to give you another kind of example on the unearned, let's say you run Noom.com, and again, on November 1st, somebody gives you $180 for a 6-month subscription. That's that weight loss thing that's based on your psychology, which is just stop eating. And when they sell that subscription, they get the cash, it goes to unearned revenue for the 180, and then it would be revenue every month. At the end of that year, you'd have 2 months worth. That would be revenue. The importance of unearned revenue concept for managers, it's not revenue until the service is provided, good or service provided. And so if you're a manager and you want to make yourself look a little better this particular year, you have to provide the good or service. You've got to be careful. You can't just say, bill me, and as long as I bill the customer, even though I haven't delivered it, I get revenue in a particular year. I can't say pay me up front. That's not going to work. To get the revenue in a particular period, you have to provide the good or service.